The whole system basically is a mess. The only protection from a collapse in the system, and believe you me, we are in the biggest credit bubble in history. And I would tell anyone, viewing this, if you wonder, why is this a credit bubble? Are you sure this is a credit bubble? Just look at the debt side. We can all agree that this is the largest amount of debt ever. And you came up with some numbers, 36 plus 200 for the US. I mean, this is the largest debt bubble. Now, the point is that credit is the other side of debt. So if it's the largest debt bubble, it's the largest credit bubble. This coming crisis, I think, is going to be so massive, and nobody has any gold.
In an era marked by monetary experimentation and rising political distraction, the integrity of the global financial system is being quietly and systematically tested. Yet, this unfolding crisis receives little to no attention from mainstream media. In this timely and deeply analytical conversation, renowned economist Alasdair Macleod joins Andy Schectman to discuss the escalating fragility within the US and global banking sectors. A fragility rooted not in speculation, but in structural imbalances that have long been papered over by central banks and policymakers. Macleod offers a sobering assessment. The American banking system, once the backbone of enterprise and economic dynamism, is no longer supporting the small and medium-sized businesses that drive growth. Instead, commercial banks are shifting capital away from productive lending towards short-term government securities, not by choice, but out of fear. Fear of risk, fear of default, and fear of a looming collapse in asset values. Meanwhile, interest rates, far from stabilizing, are poised to rise, driven not by policy preference, but by the global market's demand for adequate compensation against deteriorating currency values. As Macleod outlines, the foundational trust in fiat currency is eroding, and with it, the illusion of control that central banks once maintained. Perhaps most alarming is the reality that central banks are now operating in negative equity, caught between the imperative to print more money and the risk of triggering currency destruction. Add to that a sovereign debt burden that is growing faster than national income, and what emerges is a classic debt trap, one that resembles, in Macleod's words, the same dynamics that led to the global economic collapse of the 1930s. During the discussion with Andy, Macleod examines the signs of this coming collapse and how it will instantly drive investors to safe haven assets, like gold. As we present clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
Do you see a crisis brewing underneath the surface, or have they somehow been able to paper this over so that the problems may not be as big as some analysts have thought?
Well, there's an awful lot of papering over going on, I'm sure of that. And yes, it is a problem. But at the moment, I think the American banking system is giving a problem to what we in England call the SMEs, the small and medium-sized enterprises. They're not lending. They're not providing the liquidity that businesses need. And the reason for that is they see risk. We've seen with the commercial real estate business, for example, in various other areas. This is something that bankers just don't want to know now because they see risk. Business out in outside the main conurbations is not good. So what they're doing basically is they're lending money to the government, and they're lending money by buying T-bills. They can't destroy credit once they've created. This is the problem. The only way credit gets destroyed is when people go bust and they default. So they're stuck with credit. So what they're trying to do is they're trying to move the credit from risk to what the regulators say is non-risk. In other words, you're looking at short-term finance for government. And that's basically what the banks are doing. Now, interest rates will rise, and I can explain why. I think that's a separate question. The consequences for that will be huge, great problems developing for the entire financial system. I mean, I can see the equity market bubble bursting completely. I think President Trump's tariffs, I call those Smoot-Hawley Mark II, basically. And if you think about it, 1929, we had a credit bubble which bust. That was the Roaring '20s. And we had Smoot-Hawley at the same time, which was legislated, or it was signed into law by Hoover in 1930. It was that combination, basically, that killed the global economy. And here we are going down the same route. This is important because the banks basically are the guys, if you like, who are taking the risk on this. But at the end of the day, of course, we don't want our banks to go bust, and the central banks will do what they can to rescue them. But Andy, there's another problem, and that is that the central banks are all deeply in negative equity. People think that it doesn't matter because they can always print their way out of trouble. But yeah, if they do that, they collapse the currencies. And there is another problem, and that is that, if they don't print their way out of problems, then they have to turn around to their major shareholder, which in this case is governments, for finance. But the governments themselves are in a debt trap. I mean, the whole situation actually is all it's all set to fall over. That's the trouble we face. And that's why it's so important to understand the difference between money and credit. Money being gold, credit being everything else.
Yeah, as J.P. Morgan once famously said. And so why do you see interest rates rising? Because all we hear about, and of course I agree with you, but all we hear, the conventional wisdom is whether it be from Trump or Scott Bessent, the drive to whether it be pushed down the federal funds rate, or as Scott said, actually somehow, not quite sure how he plans on doing this other than to monetize the debt, but to bring down the 10-year yield. How do you see that unfolding?
Well, basically, you've got to understand what an interest rate is. It's basically compensation for risk. Now, if you're a foreigner, look at it from the point of view of a foreigner, if you like, being offered the option to subscribe for US Treasury debt. He will start thinking, okay, if I'm going to buy this debt, what's going to be the purchasing power of the currency which I have to buy in order to buy this debt? Now, if the purchasing power of the currency is going to decline by, say, in my estimation, say 5 or 6%, then quite frankly, to get a 4.3% yield on the 10-year proposition, forget it. No, it's got to rise. And the other problem that we have, I mentioned a debt trap. I mean, when you get a situation where GDP is growing at a slower rate than government debt, basically, the basis in which government debt is financed, or government finances are financed, is basically the revenue base, which is proportional to GDP. And if that's not growing as fast as the debt, then the debt is basically running away with the situation. It's called a debt trap. And that's really where the US government is. And it's not just the US government, it's most of the major G7s, with the exception so far of Germany. That's why interest rates rise. I mean, let's look at it another way. Imagine that this is 1923 and you're in Germany. The economy is in such a mess. It's horrid. It really is horrid. How does the government rescue things? Suppresses interest rates to zero? What? The interest rate is a reflection of the development, if you like, the evolution of the purchasing power of the currency. And if the currency is going down, and this is what gold is telling us, actually, we don't need me to tell anyone. Gold is telling us the currencies are going down, then interest rates have got to go up. It's actually quite simple.
What Alasdair Macleod describes isn't just a prediction, it's a warning about how fragile our financial system really is. At the heart of the issue is the way we've come to rely on debt, not just as a temporary tool, but as the very foundation of our economic growth. For years, central banks and governments have used low interest rates and money printing to keep the system going. But now, that approach is running out of road. Banks are no longer supporting real businesses, especially small and medium-sized ones. Instead, they're playing it safe by lending mostly to governments. This shift shows that banks are nervous. They see more risk in the private economy than in government debt. But here's the problem. Many of these governments are already deep in debt themselves. This is what Macleod calls a debt trap. When a government's debt grows faster than the economy and tax revenues can't keep up, it faces a dangerous choice. Either make deep spending cuts, which are politically unpopular, or print more money, which weakens the value of the currency. Even the central banks, which are supposed to keep the system stable, are now in trouble. Many are technically insolvent. They owe more than they own. While they can still create money out of thin air, doing so would only make inflation worse and damage trust in their currencies even further. This isn't just theory. We've seen it before, in places like 1920s Germany or during the 2008 crisis. And we're seeing the warning signs again today. Interest rates are rising not just because of policy decisions, but because investors are demanding more compensation for the growing risk of lending money. Macleod's message is clear. The financial system is being held together by weak foundations. And unless more people begin to understand what's really going on behind the scenes, the next crisis may come faster and hit harder than anyone expects. Let's get back to the video.
The United States is roughly 200 trillion in debt. We talk about the 36 trillion, but that doesn't take into account the off-balance sheet massive obligations of Medicare and Medicaid, Social Security, and all the pensions, government and military alike, and other entitlements. A trillion seconds ago was 31,688 years ago. These numbers are becoming massively. And now we find, to your point of tariffs, that we're relying on tariffs and sanctions or tariffs that masquerade as sanctions, I guess you could say as well. Not just tariffs that are trying to benefit the strategic manufacturing sectors, but tariffs that are more of a sanction. If you don't do this, then we'll do this. So that's not good. And at the same time, China and Russia are trading more in their own currencies. They are shedding treasuries. As we've seen net since 2014, there hasn't been any new central bank buying of treasuries, or there has been, but the selling has been greater. And they're also buying gold, as we know about. Now, I remember a couple of years ago, and I've used and always given you credit for this. A couple of years ago, you talked about, it was your belief that China could hold up to 38,000 metric tons. I think you said 20 by the state and 18 by the people. And I am curious to know what you think they have now. But with the rise of the BRICS and the alternative trade systems that we are watching happen right in front of us, I guess what I'm getting at, with all of these things put together, the debt, the de-dollarization, the accumulation of gold, the problems that we have in this economy, are we watching the decline of the dollar as the world's reserve currency in real time, or is that being overstated, as a lot of pundits would say?
I think, no, it's not being overstated at all, Andy. And I mean, quite frankly, the whole of the fiat currency system post-Bretton Woods is now running out of time. The reason that China has accumulated gold and Russia is doing it so as well, quite simply, is because under Marxist theory, they reckon that capitalism is doomed and the currencies will be doomed with it. The only protection which they understand, and of course you and I understand, is to tie the value of their credit, yuan or rubles or whatever it might be, to gold. And if you tie it irrevocably to gold, then you protect yourself from the mess that we in the West have got ourselves into. And we've got a real problem, because it's not just, you can't sort of just wave a magic wand and say, oh, well, just put the dollar back on the gold standard. The problem is that the US Treasury is invested in getting gold out of the monetary system entirely, and has been describing as a pet rock or whatever. And not only that, but the entire intellectual economic establishment believes in sort of, if you like, macroeconomics, Keynesian and monetary, but particularly Keynesian, and they've got to be persuaded off that. I mean, the whole of the macroeconomic thing is basically a non-science, and so you've got to re-educate the entire establishment. And he goes into the investment establishment, the investment management establishment as well. I mean, how much gold have they got? I worked it out that on average, they've probably got about 0.07% their funds under management in physical gold. There's a bit more maybe in ETFs. I mean, the problem being, of course, is that in our wonderful regulated system, gold is not a regulated investment. And if you're going to hold it as an investment manager, you got compliance on your back saying, what the hell are you doing?
Isn't that funny? Compliance on gold, but not on over leveraged equities. It's a crazy world we live in.
In fact, not only over leveraged equities, but also sort of derivatives and things like that. Well, I mean, an ETF is a form of derivative, and that's a very, very good case in point. I mean, the management costs, if you like, of holding gold through an ETF, for a start, is considerably greater than storing it in a proper insured vault. Not only that, but you don't actually possess the gold. I mean, the whole system basically is a mess. The only protection from a collapse in the system, and believe you me, we are in the biggest credit bubble in history. And I would tell anyone, viewing this, if you wonder, why is this a credit bubble? Are you sure this is a credit bubble? Just look at the debt side. We can all agree that this is the largest amount of debt ever. And you came up with some numbers, 36 plus 200 for the US. I mean, this is the largest debt bubble. Now, the point is that credit is the other side of debt. So if it's the largest debt bubble, it's the largest credit bubble. And credit bubbles, when they burst, and when they're too big for the establishment, if you like, to just sort of midwife things through, like they did in what was laughingly called the Great Financial Crisis. The next one, I can tell you, will make that look like a tea party. This coming crisis, I think, is going to be so massive, and nobody has any gold, even including mines. It's less than 1% of the total of some 300 trillion of investment assets. What we are going to see, I think, Andy, is we're going to see a huge rate portfolio shift, if you like, away from, sort of financials and away from tech stocks and all the rest of it, into mines and all the rest of it. And, the problem is, of course, there's been no money, as far as the brokers are concerned, in investing in mining research. So they haven't got the capacity, really, to deal with these portfolio shifts. It's going to be a very interesting time.
As Alasdair Macleod makes clear, the global financial system is not just strained, it is on the verge of a historic rupture. The United States is sitting on an unprecedented $200 trillion in total obligations, a figure that includes off-balance sheet liabilities like Medicare, Medicaid, Social Security, and military pensions. Meanwhile, global trust in U.S. treasuries is quietly eroding as countries like China and Russia accelerate de-dollarization, increase gold holdings, and strengthen alternative trade alliances. Macleod's insight is sobering. The entire post-Bretton Woods fiat currency system is reaching its limits. Central banks are leveraged, institutional investors are dangerously underexposed to real assets, and gold, once dismissed as a pet rock, may soon emerge as the only reliable store of value. And when this credit bubble finally bursts, as all bubbles do, it won't resemble the financial crisis of 2008. It will be bigger, deeper, and far more disruptive. As Macleod warns, the next collapse could make the great financial crisis look like a tea party. Do you agree with Andy and Alasdair Macleod's analysis? Please share your thoughts and comments in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on the notifications bell for more videos. We appreciate the support and hope to see you in the next one.